Okay, time on the show for Ask Annex. Got a question? You head to our website, annexwealth.com. Click the Ask button. If we can help, you click that Get Started button. Matt Morzy's Director of Research and a CFP at Annex Wealth Management. Hey, Matt.
Hey, Danny.
And Fred Coleman, CFP and a Wealth Manager, joins us too. Hey.
Hey, Danny.
Question 1 on Ask Annex. My grandson's 401k matches 6% of his pay. I'm telling him to contribute to that match, but invest another 9 to 14% of his pay in something else. Now, if he goes with a fund or an ETF, isn't he just doing the same thing? What should he consider for the additional portion?
401ks are nice, especially when you get that match. But the other thing that we have to think about when we are investing in 401ks is you're getting a tax deduction as well. So let's say your grandson makes $100,000 a year. He contributes 6%. Well, that $6,000 isn't going to be taxable. So only $94,000 is going to be taxable for that year because he gets that tax deduction. So that's the other thing to keep in mind with 401ks. So we want to look at what his tax situation is. And also the match is just the minimum that you should contribute. That doesn't mean that you can't contribute more. But after I've hit that match, everybody knows I'm a big fan of the Roth IRA. So after you hit that match, look at the Roth IRA. It's not going to be tied to the employer. The good thing about the IRAs is they have benefits that offer more flexibility. So you can invest in just about anything. So your grandson won't be tied to just having to invest in a set of ETFs or mutual funds. He can invest in individual stocks, and then he can also have it professionally managed. So after he, does hit that match, I would look at that next 9 to 14% in the Roth IRA, and then also don't forget about the HSA as well.
I completely agree with that. You're looking really at kind of that long-term picture of where do you want to have money and where do you want to have invested. So you're right, Roth IRA, especially if you could do that within the 401k, if they have that Roth option, that's a great way to do that there. The health savings account, another awesome way to get money in there from a tax, standpoint as well too. When it comes to investing, like you said, there's only going to be so many options available within that 401k, and they might be great. We manage 401k plans for lots of companies, so those firms have great investment options that they get to pick from. You might want to just continue to use those and just build that up over because you do have great options. If you don't, or you do want to have a little bit more of that diversification of the different tax buckets, open up another thing, and having similar types of investments is not necessarily a bad thing to do. Essentially you're looking to, at this point, if being your grandson, just assuming kind of an age bracket there, you're probably going to want to be all aggressive, all stocks in there, probably no fixed income or very little fixed income, so you really just kind of want to build on that. But if you do want to start bucketing out different risks by different tax buckets, you are able to do that. But being younger, you really want to kind of have your foot on the gas and be able to weather those storms, especially as you're just getting started out there. But ultimately, whether or not you duplicate the exact same investments is probably not the worst thing in the world. If you do want to try to diversify that a little bit, you can, but you'd have to do it outside the 401k.
Next up on Ask Annex, regarding dividend stocks, do most people reinvest or do they actually use dividends to support their lifestyle?
My favorite answer in Ask Annex is it depends. And this is definitely an it depends type of situation. So if you're in accumulation mode, you really just want to reinvest. Now, whether or not you reinvest in the exact same thing that paid out the dividend or it gets reinvested back into something else, either way, you just want that money working for you. You might have already hit a max of a position sizing that you want. If that's the case, then you don't want to reinvest back in the same thing, and you'd really want it to go into something else, maybe something that isn't performing as well, that you're underweight now, or a stock or an ETF that's down a bunch. You would rather have that free cash going into that to be able to lower your purchase price on that, and then set that up for the future growth when that comes back. But if you are in retirement and you're living off of a fixed income and that's part of your income, getting that sent out to you is, probably a really good way to do that. What we do here is not necessarily send out just all the dividends that come out, but we can create our own dividends, just a way of saying sell something. You're creating that cash to go out, and we might want it to come from someplace else, and we might want to reinvest some of that. So either way, it's kind of like that mental accounting at that point, but you do want to pull out cash flow. So if that comes directly from the dividends instead of something else, that's certainly okay.
And that's the great thing about the partnership between the wealth managers and the investment team. We can help, depending on what your goals are, customize the dividend payout plan. The one thing to keep in mind is that even if you take the money or if you reinvest it, the dividends are going to be taxed the same way. The government is going to look at it like, hey, you received this dividend, and they don't care whether you put it back in or whether you took it out. So that's something to keep in mind. The other thing that, reinvesting those dividends help with is it's a constant cash flow into the market. Dividends come whether the market is up or down. So it's like a form of dollar cost averaging. So it really helps with some volatility.
That's the way we think, folks. That's the way we act on behalf of our clients, and we can do it for you. Website, annexwealth.com. Click that Get Started button. Fred Coleman's a wealth manager and a CFP at Annex. Thank you.
Thanks, Danny.
Matt Morzy, Director of Research, CFP. Thank you.
Thank you, sir.